The controversial CAG report on coal has been tabled in the Rajya Sabha. CAG pegs loss to exchequer at a whopping 1.86 lakh crore rupees.
The Prime Minister's Economic Advisory Panel cuts growth forecast for FY13 to 6.7% from the earlier 7.5 to 8% forecast. Also raises the inflation target to 6 to 7% from 5 to 6% earlier.
Markets correct after the CAG report on coal is tabled in the Rajya Sabha. Key indices slip in trade led lower by power stocks after hitting 5400.
State-owned SAIL and Anil Agarwal-led Sterlite Industries are on their way out from the Nifty. Lupin and Ultratech Cement will replace the two metal giants on the 50-share benchmark index with effect from the 28th of September.
And European shares shared early gains after hitting a 5-month high on expectations that policymakers might resolve their differences and work closely to tackle the debt crisis.
Afternoon, you're with markets at lunch right here on ET Now.
Well, you could blame it on the CAG report. So after just about testing that 5400 mark, we've shaved a good 40 points from the lows, or rather from the highs of the day. 5360 is just about what the index is defending right now. The market breadth as well has come off quite considerably from where we started off the day. Reliance Power, Tata Power, Reliance Infra, DLF, Hindalco, Power Grid, L&T, Tata Steel, SAIL, JP Associates are your key losers currently in trade. On the flip side, there is still good going for Infi, ITC seeing some covering, Unilever and Tata Motors is holding up.
Let's get a quick market view from our technical analyst Ashwini Gujral joins in live on the show as always. Afternoon, Ashwini. Obviously, this is as a fallout of the CAG report on coal allocation. Do you think the weakness in the market will continue? Ashwini? I think we've lost the audio there with Ashwini. Try and get him back as soon as possible. But let's get in a fundamental view on the market. Then Sanjay Dutt of Quantum Securities believes that markets may consolidate at current levels, but he sees there's clearly investor appetite even now. He sees value in infra, camp goods and power companies.
We have much more liquidity in the pipeline over the next few months for India. There is a lot of opportunity within the markets in India. Of course, we would go through the process of, 3 steps ahead and 2 steps backward over the next few months, which means consolidation, base building. As we've seen, the last 100-odd points have been pretty slow in the markets. So that process will carry on, but definitely there is liquidity and there is a good amount of supply. You need to, I think, start being underweight the defensives and start being a little aggressive on the, interest rate sensitives, a little aggressive on the infrastructure, capital goods, power plays, etc. The ones that have been beaten down over the last few years. And I think more than that, if you really want big returns, you need to focus on, which I've been saying for quite some time, and of course I've been wrong with the short term, is to look at some of the good quality mid-cap companies where I think there will be a phenomenal amount of traction once the interest rate cycle and the order books, etc. start rolling in. Once see the downside of 10 to 15%, the earlier lows that you've seen, and upside is going to be huge as soon as things start looking up for them. So that's the place I would like to be, primarily into power, because power is one thing that would be sorted out in the next year or so, particularly after this freak incident of the grid failure, the amount of global attention India has got. Everyone in Delhi, all the policymakers and the administrators realize that this is one place that they need to sort out.
Okay, that's the fundamental perspective coming in on the markets. Ashwini Gujral is back with us. Ashwini, clearly we've taken a step back thanks to the CAG report and pressure on some of these metals and coal-related stories. What's the sense? Do you think the market is going to make another attempt at 5400 and what we're seeing is just a knee-jerk reaction?
It does seem that we are taking a step back and maybe we need to build momentum again at lower levels. So probably 53 to 54 is the viable range for the moment. Only below 5280, 5300 would you say that the uptrend is over. So right now it seems we are going to go in for profit booking because all of this CAG report is going to create unnecessary noise. So you can kiss all the reforms goodbye. So chances are that the market will be range bound for the moment. Also, Europe did not follow through yesterday's rally from the US. So chances are that we would correct and probably close around 53.50 for the day.
Okay, what's causing pain is, of course, that controversial CAG report on coal block allocation, on power, as well as on the Delhi airport. But more specifically, it's the report on coal block allocation that's causing much of the pain for a whole host of stocks in the metals, power and coal space. Let's take it across to Nithya Balakrishnan and Gargi Parikh for more on that big story that we're tracking right here on ET. Now, Nithya, to you first. Obviously, the loss figure was along expected lines, but help us understand which are the companies that have been named in this CAG report now.
Well, Sandeep, a whole host of power companies under the line of fire, clearly, as the CAG report was tabled in Parliament earlier today. We're talking about the likes of Tata Power, Adani, Hindalco, SR. There were names like Bhushan Steel, Tata Steel, amongst others. Most of these mines, however, interestingly to note, were around the areas of Jharkhand, Orissa and Chhattisgarh. Names like ArcelorMittal also came to the fray. We're talking about Monnet Ispat. So, an entire spectrum of power as well as steel companies have been named as beneficiaries in the CAG report, quantifying that 1.8 lakh crore rupees were the windfall gains to private power players due to allocation and not auction of coal. Interestingly also, the PMO has received a clean sheet. It is the screening committee that the CAG has lashed out on, saying there has been absolute no transparency in policy of allocation of coal blocks. And its recommendation, more importantly, will have an impact on all the power companies. It says there is an immediate need to switch to the auction mechanism when it comes to allocation of coal blocks. Competitive bidding is the way out. This means a formulation of policy and much more stringent regulatory checks by not just the coal ministry but also the coal regulator who's being proposed is likely underway. So a whole lot of scrutiny on power companies by the government, simply because the CAG has said that there has been absolutely no transparency in allocation of coal blocks till date.
Let's bring in Gargi as well. Gargi, list out the companies mentioned, because clearly the stock markets are hammering the stocks.
That's right. The big companies that have benefited from the coal blocks that were allocated. In fact, the CAG report has come down heavily on Reliance Power, and if you look at the comments coming in from there, they've mentioned the overall benefit of close to 29,000 that has come, to Reliance Power's way. If you look at the Sasan coal, that they've mentioned that there has been undue advantage that Reliance Power has got really from the Sasan coal. In fact, they've gone ahead and said that there should actually be a review of the allocation of the Chhatrasal block for Reliance Power, and that probably is the reason why the stock is going down so heavily. Other companies, like Nithya mentioned, we have a Tata Power, they have a Sterlite, Hindalco, Monnet Ispat, Bhushan Steel. All of these have been seeing a negative reaction. Remember that these captive blocks are really important for either the sponge iron, steel or the power plant that these companies have, and any change in policy from, that may affect the usage of these captive coal blocks, that could impact these companies severely going forward, because most of their plans are based on the captive coal that these companies would have got from the blocks that were allocated. For now, we don't have clarity on what will happen in future, but this is more or less a sentimental reaction coming in. Reliance Power, probably showing the drastic reaction that we are seeing. However, a whole host of smaller companies also, like a Prakash Industries and Navbharat Ventures, a lot of them also have been seeing a reaction, because these companies were really betting on captive coal for maintaining their margins. Otherwise, their projects go ahead and become unviable. So clearly, just a sentimental reaction. We have to wait for the way ahead on what is going to happen on this report. What is the final judgment that is going to come in? We still have to get some clarity on that front.
Oh yes, market is taking these stocks, putting them under a bit of pressure there. Gargi Parikh and Nithya Balakrishnan, thanks for getting us your perspective on that story. But let's also get you reactions from stakeholders. We at TT now have been speaking to some of the biggest experts over the last hour or so. First, get your reaction from Ashok Khurana, Director General of the Association of Power Producers, and also from Sandeep Jajodia, Chairman and Managing Director of Monnet Ispat.
It is very, very difficult to find out how windfall gain can come. It is a non-tradable commodity, and as per the present policy framework, the developer can't even divert 1 ton of coal. So there is no policy flaw. Now, there may have been certain specific cases of misuse or diversion.
The general idea I have about the report, I think this kind of calculation itself is very misleading. Because, something which has been given on captive basis and one can't sell that coal, to put a price tag to it and calculate the cost of production and then take out a figure of profit, I think that whole approach itself is wrong. 3 successive governments have actually gone ahead allocating blocks in a certain manner. Now, in retrospect, to say that this is wrong and, some huge benefit has been given to private companies, I think it's totally wrong. I mean, it's totally misleading.
Okay, the other worrisome economic data point today has been the Prime Minister's economic panel, which has cut the growth forecast for FY13 to 6.7% from the earlier 7.5% to 8%. They've also raised the inflation target to 6 to 7% from the earlier 5 to 6%. ET Now's Supriya Srinath caught up with the PMEAC chairman C. Rangarajan and began by asking him if the 6.7% growth rate was rather optimistic given the global brokerages which have predicted a sub 6 to 6.5% growth rate for India.
I think we have looked at the potential that exists in the various sectors of the economy. We have done a detailed analysis of the possible growth rates in the various sectors such as agriculture, mining, construction and so on. And we have come to the conclusion that the potential exists for the economy to do a little better than last year. We did even under the worst circumstances at 6.5%. If anything, in many of the sectors of the economy, the growth rate can be higher. And therefore, overall, it is possible for the economy to grow at 6.7%.
You are very positive on manufacturing. You are giving it a much higher growth rate than last year, and you expect it to pick up in the second half. Where is your optimism coming from, considering the latest data is not very optimistic right now?
I think the growth rate in the first half of last year was quite robust in the field of manufacturing, and therefore we are measuring in the first quarter of this year against a very high base. In the second half of last year, the manufacturing growth rate came down quite sharply. As against that particular background, I think there are indications that sectors like coal, steel, cement have shown improvement, and therefore overall growth rate higher than what was experienced last year is possible in the field of manufacturing. In fact, even then, the manufacturing growth rate will be much lower than what we have seen in the previous years.
So the fiscal deficit target, yes sir, the fiscal deficit target, there are 2 things that will bridge the fiscal deficit. One is inflation, one is fuel prices, and the other is GST. Both these things don't seem to be happening.
GST will have only a long-term impact, not in the...
but both things are not going to happen, sir. So is there a